Welcome back here with Money, 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 and we're in conversation with NIMESH, MD and CEO of ICICI Prudential Asset Management Company to find out how to make money in financial year 2018. So, NIMESH, I'm going to ask you to wear the advisor's hat for a change. Very different. It's not something you do. But let's say, if you were to talk about the entire ICICI Pru universe of funds, and if you were to look at someone like me, maybe, you know, young working professional, medium risk appetite, looking at investment ideas in this year, which are the funds that you think will work?
When we are in the market with the trailing PE of about 20 and with the forward PE of around say 2018, 19, 17, with that in background, I would say with the flows uncertainty, that dynamic asset allocation as a category is a very good category to invest in. Dynamic asset allocation means that we invest part in equity and part in debts, but the ratios we keep on changing based on the level of the market. So we have got a specific fund, ICICI Prudential Balance Advantage Fund. So what we have done in this fund is if the market price to book ratios are high, we have a higher allocation to debt and a lower allocation to equity. When the market becomes cheap, and we do daily allocation, of between equity and debt.
And price to book being the measure.
Based on the price to book ratio of the market, which we believe internationally has also shown that it is a much better indicator, we will fluctuate between debt and equity. So you don't have to worry in your busy life whether this is the right time to invest in equity or not. It is like a SIP. SIP, you're not timing the market. This is one time SIP. If you want to invest one time, this is a one time SIP where we allocate between equity and debt. So if the markets are 31,000 and at that time you are coming in, I would automatically allocate more to debt and less to equity.
And the benefit here being that a SIP will keep buying even as the market is going higher, because that's the nature of the product.
So,
but here, the fund manager can change that call.
The fund manager does not do. The asset allocation, there is a discipline of algorithm. The fund manager cannot take a call how much to put in debt and equity. So that call is without any emotion, without any beliefs. That call is based on past history, that how the price to book ratios in India have behaved.
And I remember that you were quite excited and you were optimistic about this type of fund, dynamic asset allocation, even last year. So if you look at returns over the 1 year, the fund has delivered almost 17-18% returns. Is that a realistic expectation to have even for future, though we know that past performance cannot be taken as a measure?
Definitely I cannot say that this fund will give 17% return next year also, because it depends on where the market is today. So, but what is the beauty of this fund? If you see the last 5-6 years, though the weightage to equity has been around 60%, give and take, it keeps on fluctuating based on the level of the market. So you are taking 60% of the risk of the complete fund. Still you have got a return which is more than the market. So that itself is a very heartening thing. We are very happy. It is one of the biggest funds in the industry. One of the biggest, it is the biggest fund in the industry. And customers' repeat purchases are keeping on happening in that. So even if somebody wants a dividend option or a growth option, I think right from HNIs to retired employees, I am very comfortable people investing money in this fund, because risk is controlled. Investing is all about managing risk, and in this fund, the algorithm is managing the risk quite well.
All right, that's a pretty interesting concept. Let's talk about a pure equity fund as well. We know you've already spoken about infra. I mean, that's where value investors can perhaps look at that fund. You mentioned you like it as a sector, as a theme. What else in pure equity?
If it is relatively new, we have got a fund which takes, again I'm talking on risk control, ICICI Prudential Focus Blue Chip Fund. It does not take any sectoral bets. It's a very boring fund, I would say. The whole idea of that fund is we want to beat benchmark by 300 basis points. The fund manager is told very clearly, your only target is to beat benchmark by 300 basis points. We don't want more returns in that. Right? 300 basis. So if I believe on a consistent basis, if we are able to give an experience, almost 36 quarters this fund has been in existence, and except 4 quarters it has always beaten the benchmark. So that's the 4 or 5 quarters it has not beaten the benchmark. Every quarter it has been able to beat the benchmark. And if you want a pure play of equity and want to take a sectoral bet in this time when the whole government is looking at, we believe private sector is not investing today, so government is going to invest big time in infrastructure over the next 2 years before the May 2019 election, and if we 2 years of infrastructure investment, we can ride on that. That's what
I also want to talk about the Focus Blue Chip Equity Fund, and how you see that, and the question that's being always asked, whether to go via the passive way or the active way when you're looking at large cap. So you want to have obviously some amount of large cap exposure in your mutual fund portfolio, and this argument is always thrown that ETF will have a lower expense ratio. So will India start looking, and retail investors, will they start looking more at ETFs in the year to come?
Retail investors should look at ETFs, in my mind, when we are not able to beat benchmarks. Right, as long as my funds are beating benchmarks, as long as ICICI Prudential Focus Blue Chip Fund, after deducting my fees, is beating benchmark, then it has to be a good bet, whether you want to earn more than the benchmark or you want to earn benchmark. As long I am in the business, still I am able to beat benchmark. If I can't charge fees if I am not beating benchmark to that extent, right? So I think our customers are had a good time. Well, because we have been able to beat benchmarks till now. Will
we see more ETFs from the ICICI Pru stable? I mean, there's been so much of talk, the CPSE ETF, and then we keep hearing that maybe some of the stake sales from Suti, for instance, the government wants to do maybe another new ETF to manage some of those sales.
So that is a structured around a particular theme, right? The government divestment and the government companies which are available very cheap. So we should be able to, we are talking with the government, we have won that mandate on the ETF, and we should come with the CPSE ETF at some point of time when the government wants to do. So it would be a very interesting concept. So that we are moving towards from a plain vanilla ETF to a smart beta kind of model. Ultimately it's a smart beta. So I am a great believer of smart beta products will come in India rather than plain vanilla. If I can structure a ETF well, where there are pre-decided companies or pre-decided formulas based on themes, based on which I can, again my algorithm-based investing. We have worked on a lot of interesting ideas on the smart beta side. So at some point of time we'll come out with that.
Okay, we're going to take a break on that note, but on the other side, we will actually talk about the very complicated world of debt mutual funds because everybody wants to beat their FD return. What are the avenues in FY18? We'll ask Nimesh.